nothing I can do. I feel so bad, yeah. I feel so blue. I got to make it right for everyone concerned. Even if it's me, if it means it's me, what's getting burned? 'Cause I could never make.
Hi, everyone. I'm Lisa Hoover, of course, you know that. And I just wanted to, have give you another perspective. As I told you, we're doing a series on, you know, mortgage lenders slash brokers and trying to just give you some information. Because a lot of times what I've heard from my clients and people on my channel are that by the time you get to this point, you're so afraid you don't ask the questions. So what I decided to do is that, hey, I'm going to ask the questions for you. At least that's a start, right? And you get to hear different perspectives, but they're the experts, not Lisa. I want to make that clear. And so I want to give them the opportunity to do so. So we're going to get started. If you could introduce yourself.
Thank you for having me, Lisa. My name is Derick Hungerford. I work for a company named Residential Mortgage Corporation. We're in Largo, Maryland. I've been in the business since 1993. So over 30 years of service. I was thankful and grateful to be able to help about 3,500 families and counting to buy their homes and to refinance homes. But the biggest thing I like about what I do is that I can talk about the biggest thing or the biggest asset and the biggest liability that a person will ever have. So it brings me great pleasure to be here with you this morning.
All right. So can you tell us a little bit? You gave us a little bit of that in your intro. Can you tell us a little bit about your background and how you became a mortgage broker?
So, a lot of times what we say is a lot of people in this industry, we just kind of like fall into the industry. And that kind of happened with me. I did go to school to Hampton University. I graduated from Hampton University with a BS in management and marketing. I always knew that I wanted to work in finance, the finance arena. I did work for a Fortune 500 company where I help people with 401ks and annuities and insurance products. And then they brought in a product that we could help people with, which was called home equity loans. So we started to do that a little bit. And I realized I can be more of a help for my clients if I help them with the biggest asset that they could have. And so I delved out into the mortgage space, and I worked for a bank in Virginia for a while, and ended up migrating back over here to Maryland. Opened up a branch for that bank, and then branched out with Residential Mortgage Corporation. Again, it's the biggest asset that a person will have. So it gave me great pleasure to kind of help with that asset.
So what do you enjoy most about your job?
Um, Solving problems. I
Mm,
mean, this is a problem. People don't have $300,000 and $400,000 to buy a house. A lot of people haven't figured out how to do it. A lot of people have not purchased. They should probably purchase. And I love putting people on a path of home ownership because I know that that is the centerpiece of their wealth building strategy. So again, that brings me pleasure. Just, we have families, we have people whose family has never, ever purchased a house in their family ever. And so to break that generational cycle, to help people get into a house that they thought that they would never, ever be able to get into, that's a blessing. That really is a blessing.
okay. All right. Thank you for that. The next question is, what are the current trends in the mortgage market that buyers should be aware of?
Good question. So you probably know that we're in an elevated interest rate market right now. Interest rates are in the 6% range. They came down. They came down from 6.8 to 6.7. I believe that we're going to still see those coming down a little bit. But we're not going to see the 2.99s and a 3% and a 4% anytime soon, if ever. I think that in 2024, we'll get down to about 6.5%. I think in 2025, we'll make it down to about 6 and 6.25%. But I do see more people getting into the market and understanding that this is where interest rates are going to be. If you look at it from a 30-year perspective, the average interest rate is about 6%, 6.5%. So we're in a normal market right now. The market where we had 3 and 4%, that's an anomaly. And I don't, again, think it's going to get there. And I will say that this is a great time to jump out there, because one thing you can change about getting a home or a mortgage is you can change that interest rate. So when interest rates come down, you can refinance, get a lower rate, lower payment. But the other thing that you can't change is how much you pay for that house. And so Warren Buffett said it very frankly. He said, look at what average people do and do the opposite. So you don't want to really wait until a market, in my opinion. You don't want to wait until everybody's jumping in the market, because now you're going to have pricing wars, bidding wars. Prices of homes will go up at that particular time. And as I said before, you can't change the sales price of that, but you can change the rate once the rate comes down. So I'm of the opinion that you get in when you can. If you qualify, it's always a good time to buy real estate. Buy real estate and wait. Don't wait to buy real estate is what I always say.
Okay. Can you say that again?
I said, don't wait to buy real estate. Buy real estate and wait.
Okay. So when you said a minute ago, you talked about an elevated market. Could you explain to us lay people what that means?
So when you buy a house, it's always about supply and demand. You're going to look at how many houses are in the market compared to how many buyers there are in the market. So if, for instance, there's not a lot of buyers in the market, then that means the sellers are more willing to negotiate with you. They are more willing to pay some of your closing costs and maybe bring down the sales price of the home. So let's say you go to a block where there's one house on the market and you only have 3 people out there that's looking to buy that house. That's going to make the buyer, they don't have a plethora of people that they're looking for. And so that's going to make the buyer kind of make some decisions. But if they had 10, 15 people looking at that same house, they got a lot of decisions. I mean, they have a lot of people looking at the house. So, they're not going to be as proactive in terms of negotiating if you have 10, 15 people looking at your house. If I have 1 or 2 people looking at my house, I'm going to be very careful. I'm going to negotiate. I'm going to make sure that 1 or 2 people really get what they need to buy my house.
Okay. How do you see the market evolving in the next year? You alluded to this a little bit.
Yeah, again, I see rates coming down a little bit. I don't see rates coming down by 2% or anything like that, but they will come down. That means more people are going to get into the market. You're going to have more sellers selling property, but there are going to be more people on the other side looking to now jump into buying a house. And what happens with that is now you have competition, as I was just saying. So the supply is still, because right now we have enough supply for about 2 months. We're thinking that that's not going to change pretty much. So once the interest rates come down, what's going to happen is more people are going to jump into the market, and more people are going to jump into the market bidding on those small amount of homes that are out there. And then sellers of those properties are going to increase the purchase price. And again, now you're in a situation where you have a bidding war. People are paying $20,000 and $30,000 above the asking price, which I don't like that market, but that's what happens. And so I think that's where it's going to go for the people who just simply wait.
Okay.
But the flip side is the fact that the interest rates will be down. The purchase price may be up a little bit, but I think more and more people will start to get into the market as the rates come down.
Okay. And so when you talked about having 2 months supply, can you explain to our clients and the viewers out there exactly what you mean by that?
So usually in the market, you want 5+ months of supply of real estate. That means that, there's enough property to go around for people to buy. Because of what's happening with the interest rates, sellers are more, they're not making the decision to move out and to sell their property to go buy a property, because if they do, now they're going to have to buy a property at a higher rate. And so usually we have a lot of sellers out there selling property because they want to upgrade and get enough property. But in this particular environment, they would probably buy a lower price house if they're downsizing and still pay the same amount because of the interest rates. So those who need to downsize or even upsize, they're simply staying in their property for longer now, waiting for rates to come down. And so that means that we don't have a lot of properties on the market, only 2 months supply. So once it get up to about 5 months supply, the market changes a little bit. But right now, it's still a seller's market.
Okay. So can you walk us through the typical mortgage application process?
Typical. Okay. So the first thing you want to do, I've been in this business for 30 years, so I don't know if there's a typical. But I will say the first thing you want to do in your mind as a buyer is to determine how much money you want to pay on a monthly basis. I always say, don't let a loan officer dictate to you what you should buy, what you should pay on a monthly basis. There are things that we don't know about your budget. There are things that we don't know about your spending habits, but you know exactly how much you can spend on a monthly basis. Because more importantly than getting the house, we want you to keep the house. It does us no good for you to get into a property and then end up having to give it up in a foreclosure. So determine your budget, kind of look at where you want to be. The next thing you want to do is get pre-qualified. Pre-qualification simply means based on verbal information that you give to a loan officer or a mortgage consultant like me. They will give you a pre-qualification based on verbal information. The next step would be a pre-approval, which is better than a pre-qualification because now we're going to collect certain documents, pay stubs, W-2 forms, all those written documents to actually look at where you are to determine if you can get pre-approved. And that's an automated underwriting system that we put your name through. It comes out and it says approved. And when we get an approved from what is called desktop underwriting, that is an actual bona fide approval. Now, it still needs to go to the underwriter, but you do have an approval at that time. The next level that we like to take it is for you to be a certified home buyer. And that's a little different because you want to get all of your documents into the loan officer. Everyone doesn't have a certified program. We have a certified program where we actually get everything to the underwriter, get them to totally look at your profile and give you a full approval. That way you can go into a seller saying, hey, I can go to closing in 20 days. I can go to closing in 25 days. We like to do that so we can separate you from the pack where the average person is asking for 30 days. So again, you get your documents together, you get pre-qualified, you go out and look for a property, you find a property, put an offer on it, prayerfully you'll get a ratified contract. And then once we get the ratified contract, that's when the processing actually starts. And if you're a certified home buyer already, the only thing we need to do is order title, get the contract in, order an appraisal, and order an inspection. I say that out of order. You want to get your inspection before you get the appraisal. But once you get the inspection and you decide to move forward, we will order the appraisal, make sure the value of the house is where you need it to be. If the value comes in higher, that's an awesome thing. Now you have equity. If the value comes in lower, well, there needs to be some negotiation in there. If the appraisal comes in at the amount that you're paying for it, well, that's a good thing as well. So once we get the appraisal in, we get all the other conditions submitted to the underwriting department. They sign off on your loan, and then you go to closing, you get your keys, and the seller get their money. So a lot of nuances within that process. But I will say that the underwriter will look at three primary things that you really want to make sure that you get under control. And that is your debt to income ratio. So they'll look at how much money you have going out the door as opposed to how much money you have coming in. That's going to give you a percentage. Usually your percentage, we don't want your percentage to be over 50%. Simply means that 50% of your money, including that new mortgage payment, will be going to pay your bills. So that's the first thing. The second thing is credit and credit scores. So the higher the credit score, of course, the better the program, the better things that you can get. Now, we can go all the way down to a 550 credit score, believe it or not. The difference is this. Now, a lot of people think the difference is the interest rate. The interest rate will be a little elevated but that's not really the biggest difference. The biggest difference between a 550 credit score and a 750 credit score is the process. The underwriters will ask for a lot of information. And I usually say that when you go through mortgage, you want not only the product, but you want the process to be where you need it to be. But the lower the credit scores and the more nuances you have going on with your credit situation, the harder the process. They ask a lot of questions. So you want to keep that in mind. And then the last thing that they look at is money. Where is your money coming from? Do you have a 401k? Do you have a thrift? Do you have savings? Where is that money coming from? Because they're two biggest costs when you buy a house. And I don't know if you're going to ask this or not, but the two biggest costs when you buy a house will be, I'm sorry.
I said, yes, I will, but go ahead.
Okay. So the two biggest costs that you have when you buy a house will be your down payment, and then it would be your closing. Now you'll have some ancillary costs leading up to that, like your credit report, your appraisal, your inspection, homeowners insurance. Those will be due prior to you going to closing. So you have to have that money and your earnest money deposit. But once you get to a point where you're about to go to the settlement table, you're going to need your down payment and you're going to need your closing costs. The down payment is about 3.5%. If you're going with an FHA loan, which 90% of all first-time home buyers use, that down payment would be 3.5% of the purchase price. So it doesn't matter whether it's $300,000 or $3 million. 3.5% of that will be the down payment. And then you have closing. Closing will be anywhere between 5% and 6%. So I for years have told first-time home buyers or home buyers in particular that when you're going out and looking for a house, you pretty much need about 9.5%. 9.5%, some for your down payment, some for your closing costs. So you can actually do that calculation while you're out there looking for a home. And then the next thing you ask yourself, I'm sure, is, okay, where's this money coming from? And I don't know if you're going to ask anything about programs or anything, but that's when programs will start to come in place to try to help you with the down payment and closing costs. But those are the biggest costs that you're going to have when you buy a house.
Right. So what are some of the common challenges that applicants overall face, and how can they overcome them?
So those three areas that I just talked about, debt to income ratio, let's talk about that. That is having too much debt. And that is a big problem because you don't want your debt to income ratio to be, again, above 50%. So really kind of look at that number now. And all you need to do is take your rent payment, whatever you're paying in rent. And if you're paying rent, know that if you're paying $1,800 in rent in 10 years, you would pay $250,000 in a mortgage. So you want to get rid of that. I just want to ease that in there. So take your rent payment and then all of your contractual bills. I'm not talking about electric, gas, water. I'm talking about credit cards, car loans, student loans, and all those things. You add all of those together and divide that by your total monthly gross income. If your debt to income ratio right now is above 50%, then you're going to have to start working on that. And how do you get around that? Well, you have to pay down some of that bill, those bills, that debt is what I was going to say. So you want to eradicate as much debt as possible. Now, I would not start moving on that until you got further direction from your loan officer, because sometimes, we get clients who are focusing on a debt and a payment is only $30. The balance may be $8,000, but if the payment is only $30, that's not really hurting your debt to income ratio. So although I'm saying I want you to get counsel before you do anything, before you pay off anything, because that's going to be important. So keep your debt at the minimum. Keep your debt at the minimum. The other thing will be, again, having money. Money probably, I would say, is the biggest issue that people have. People just don't have 3.5%, all of these thousands of dollars to put down on a mortgage. And we got it. We understand. So for you're going to have to go with the program. You're going to have to get your credit, which is the next thing, the credit and credit scores up high enough so that you can qualify for some of these programs, so the programs can help with the down payment. And then the other thing, again, debt to income ratio is an issue. So you may or may not be able to do a lot with that right now. The amount of money for the down payment closing, that may be an issue, but there's hope because there are programs for you. And then the last thing would be credit. Again, credit score, you got to get it as high as possible. You just want to always work on your credit. Even after you get your house, you have to work on your credit report, because if you get your house and you have a higher interest rate, you want to refinance to get that into a lowest interest rate environment. And without having a high credit score, that won't happen. So with that, keep your balances at a minimum of 30% of the credit limit. So if you have $1,000 credit limit on a credit card, keep that balance down to about $300. And then make the monthly payment, the minimum monthly payment. Don't pay it off. A lot of people think that, okay, if I pay off this credit card, then my credit score is going to go up. No, your credit score will probably go down. So keep the credit balances as low as 30%. Pay everything on time. You'll be surprised how many people are going through the home buying process, and in the middle of the process, they decide not to pay a $40 monthly payment. So please make your payments on time. That can just mess you up by about 50 points by making a late payment while you're in the process of buying a home. And then don't open up new credit as you go through the process. I would stay away from that unless you're being counseled from a loan officer where they're telling you that you have to increase your credit score. Sometimes you have to open up credit to do that. But in general, you shouldn't want to open up any new credit during the time. And if you have a collection, you may have to get that paid off. If it's a charge off, we don't really worry about those. So a lot of people go in, pay off their charge offs. Well, if you pay off a charge off, what's going to happen is your credit score is going to take a dip, and then it's going to take some time to come back up. Even some collection accounts, if you pay it off right away, it may go down. So you have to have counsel to determine what to pay off, what not to pay off, and how to pursue that credit. So those are the biggest three things that people have issues with.
So two things I wanted to kind of address before I go to my next set of questions is earlier you indicated that you were a loan counselor. So what's the difference between that and a loan officer?
I said I was a certified mortgage consultant.
Oh,
So I'm certified. So that means that I went through a training that I'm a part of, that we not only look at the mortgage as a mortgage, but we look at it as a overall financial planning
okay.
mechanism. So I can talk to clients about tax effects and financial planning and things of that, so I can make sure that they understand that whatever they're doing right now should be linked to their short-term financial obligations, and also growing your asset base long-term.
Okay. The other question is you indicated that if you make a payment sometimes or pay it off, your credit score goes down. Can you tell us why that is?
So if you make a payment on an account that's
Right.
like collection account or something like that.
That.
So sometimes you have collection accounts on your credit bureau that have been on there for a while. And the credit bureau, it's dormant. It's really not affecting your credit score. So if you go in there and you make a payment, guess what? It's going to wake it up. And so the credit system will say, oh, you did have a credit issue here. So therefore, now that you paid it off, it's going to wake up the system. Your credit score is going to go down before it goes back up. And that's why if you're going through the process and you need to do that, you want to do that sooner than later. But yeah, and think about it again, that can go down by about 50 points. I've seen 100 points.
Wow.
So you want to be careful with that.
Okay. Next question. What advice would you give? What advice would you give to someone buying their first home?
I would say come up with your goal, stick to your goal, stick to what you have decided to do, and don't let anything get in your way. I will tell you this, whenever you make a decision, and there's a difference between making a choice and a decision. I've talked to plenty of people who made a choice to buy a house. I broke up.
Yep, you broke up for a second. Yeah.
Okay. I've talked to people who have plenty of people who have made, can you hear me now?
Yes.
Okay. All right. Very good. Once you decide that that's what you want to do, my advice and counsel to you is just stick to it. Stick to it. Don't let anyone take you off your mark. What I do know is that there's a difference between making a choice and making a decision. A lot of people make a choice, but you can choose to do something else the next day. And so what I'm saying to you is if you think this is for you, make a decision to do that. The word decide means to cut off from any other options. And so you want to decide that this is the thing for you, because another thing that will happen once you make a decision, then disruption will come, distraction will come, things will happen to take you off your focus. And so I know that financially successful people, what they do is they focus in on intention. Be intentional about what you're doing. And unsuccessful people, they focus in on distraction. They let the distractions take them from thing to thing, and then they get off focus and they never get their home purchased. I wrote a book called A Mind to Build right here. I think you know about this, Lisa. So this was for first-time home buyers. I wrote about a person in this book that was going back and forth about buying a house. This was years ago, going back and forth about buying a house. And one day they chose to buy, the next day they changed their mind. And at that time I wrote the book, I was very frustrated with him. I know him. Do you know that I saw him? I saw him this past Sunday for the first time in years and years.
Wow.
And what I said was wild too, because guess what?
What?
He never bought the house. And this has been years and years and years. So that person, and in the book, I talked about, okay, at a $1,200, $1,300 payment, this is how much you're losing. This is the tax effect that you're losing. This is where you'll be in 10 years if you buy a house. And he still hasn't been able to do it. So make a decision, stick to it, stick to your guns. Yep.
Okay, good advice. What are some common mistakes first-time home buyers make?
Oh, changing job positions or changing jobs. Now you can change a job position if you're doing a lateral move, or of course if you're making more money. I had this client recently who decided to take a demotion for a new job while he was in the middle of buying a house. And so now his new income didn't match up to what he was buying, and so he's not able to buy the house. So don't change your employment situation. Making late payments while you're going through the process is a killer. That can decrease your credit score by 100. You can be at a 650 credit score and go to a 550 credit score, and you cannot buy a home at a 550 unless you have 10% down. So keep your credit. You have to make sure that you keep your credit. Another thing is taking on new debt. I remember I was working with a client who we had a approval, we had a clear to close. One thing an underwriter will do, so that you can know, is although they'll give you your approval, they're still checking in on you. They're checking up on you. They're still making phone calls, and they will make phone calls to your employer 2 days before closing. What another thing they'll do is they'll pull another credit right before you go to closing. And in this case, we had a clear to close, ready to go to closing, and this young lady decided to go out and buy a Mercedes Benz. The purchase, the monthly payment was $549. I'm never going to forget it. So right before closing, 2 days before closing, or whenever she went out, bought a car, the underwriter ended up pulling the credit report again, seeing this inquiry, realizing that was a Mercedes Benz, and then she wasn't able to buy that house. Wow. That income ratio was blown out. So don't make those mistakes and those choices. I would say just stay away from getting anything while you're going through the purchase of your house. We had another person who decided to go out because they got approved for their loan. They decided to go out and get furniture. We got a new house. I need new furniture. They went out and got a truckload of furniture delivered to the new house. So they had a truck of furniture in front of the new house. The underwriter pulled another credit report, saw that she had furniture on there, credit score went down, and she had a payment, and her debt to income ratio was busted from there. So those are the kind of things those are the big things that you don't want to do. But the biggest thing is keep your credit up to date, pay everything on time, save your money as much as you can, and then be careful. Lastly, is just be careful with who you listen to. Too many people in a transaction will cause confusion. And so you want to listen to your professionals, and you don't want to allow this to become so emotional for you that the decisions you make are not to your best interest. I see people kind of going on a roller coaster, and it can be stressful. It doesn't have to be stressful, but you want to separate the emotion from the home buying experience. Is it an emotional decision? It is. However, you got to get to a point where you understand that money is not emotional. Money is tactical. And this is a tactic that you're using to build your financial wealth. And so you got to kind of separate that and understand that, hey, the things that I'm doing right now is a tool. And because when you really emotional, then you can make some bad decisions, and I've seen it. You can do some things that's going to hurt you financially. So those are the things that I would say as you go through the process, keep in mind.
Okay. So since we're talking about credit scores, how important is the credit score to the mortgage application process?
The credit score?
Yep, the credit score. How important is it?
Oh, it's one of the top three that I just talked about. It's paramount. I mean, you can't, if your credit score is 400, you can't buy a house.
Right. Right.
You just can't buy a house. So the credit score is very, very important. The higher the credit score, the better your chances are getting a home. And again, you can get in, we do 580 credit scores. We do 550 if you have 10% down. We do 580 credit scores, which is the minimum that FHA will allow at a 3.5% down. So you can get in a house, but again, now they're going to ask you like all sorts of questions. They're going to draw blood from you. They're going to want your firstborn. It's going to be the process at that time, not necessarily the product. And also your interest rate may be a little higher, but yeah, the credit, if a person has good credit and no money, then you're good to go. But if you have money and you have, challenging credit, it's tougher. It really is. So good credit will give you credit.
Okay. All right. What steps can a potential buyer take to improve their credit score?
They can, number one, pay everything on time from now on until you go home to the Lord. Pay everything on time. Just pay it on time. Okay. If you can't pay it on time, pick up the phone, call your creditor, and let them know. Pick up the phone when they're calling you. Don't duck their calls, because that gets them mad. But pay everything on time. Number two is keep all of your balances down, again, to 30% of whatever the credit line is, whatever the credit limit is, keep it at 30%. Number three, make the minimum payment on these credit cards. The minimum payment. Again, if you pay the credit card or the creditor off, your credit score will go down. So make the minimum. Now I'm only talking, Lisa, about if you're trying to get a higher credit score. If your credit score is already high, then you kind of do things differently. But this is, how do I get my credit score as high as possible and keep it there as I go through the process? So those are the three things: pay it on time, and communicate with your creditor. Number two, you get the balances down to 30% or whatever that limit is. So if the limit is $1,000, get your balance down to about $300. Number three, make the minimum payment every single month. And know this, that a mortgage, the credit system looks at a revolving line of credit like a credit card and things of that nature. They look at that more than they look at an installment. So it's more important to have a credit card with a revolving line of credit. It shows them that you know how to manage your credit report or your credit. When you have a car loan, it's just an installment loan. You pay it on a monthly basis. That doesn't give you a lot of points. The credit cards and loans do.
Okay. Next question. Let me see. The next question is, what are the different types of mortgage products that are available?
So the major mortgage products are FHA, VA, conventional, and USDA. I'll just start with that. So the first thing you want to do is get approved for a loan. And then you want to figure out what type of program you can add to the loan. You understand? It's two different things. A lot of people kind of get it mixed up and they think the program is the loan. No, the program is something that you use. It's a tool to add to a loan so that we can minimize how much money you need out of your pocket. So there are four major loan types. One is conventional. Usually your down payment on a conventional will be between 3 and 5%. There's FHA. The down payment on FHA is usually about 3.5%. There is VA. If you're a vet, that's 100% financing. And then lastly, you have USDA, which is 100% financing if you buy in certain areas, which is a great program if you decide to live in those particular areas. So those are the major types of loan products.
Okay.
And then from there, Lisa, I don't know if you want me to go into the programs, but from there, if you're struggling with coming up with money for your down payment, you will find a program to add to the product so that it can minimize your down payment and or closing costs.
So you're saying basically you need to get the loan first, and then we'll worry about the program, not the other way around.
Not the other way around. You do have in mind. That's why the initial consultation, from what we do an initial consultation that determines, okay, what you need. Because
Okay.
if you need a certain program, then we're going to go in that direction. So that initial consultation where we kind of flush out all the positive strengths and your weaknesses, because we're going to try to accentuate your strengths, minimize your weaknesses, determine the program to put to the product, and then we can go forward there. But you do need to get into a product before you can get a program. Most people say, okay, I heard there's a program out there that's going to give me 3% for my down payment. Yeah, there is a program, but can you get approved for a loan first? So we do both of them pretty much at the same time. There's no double underwrite or anything like that. It's one underwriting period of time where they underwrite for the loan, underwrite for the program, and then that's how you kind of determine how much money you can get.
How
Does that
should a
make
buyer?
sense?
Yep, it makes a lot of sense. How should a buyer choose the right mortgage product for their needs?
Well, it will depend on their weaknesses, and that's why the initial consultation is so important to determine their weaknesses. And you may or may not know your weaknesses. So sitting down with someone like me, we would go through, okay, this is what the underwriters are looking for. Which areas are you strong in? All right, so we can put that over here. Okay,
You broke up.
which areas are you weak in? Right, so we have to devise a program. Okay, we have to devise a program so that we can get you into a program that's going to get you the best program that you need for your situation. So that's when the initial consultation comes in to determine where you are. And again, we want to minimize the weaknesses as much as possible. And how do we minimize your weakness? We find a program, we find a way to do things, we find these things on this side to minimize those weaknesses. And then for your strengths, we accentuate that. And so we presenting this to the underwriter saying, hey, look at this client. They've been they've been renting for 5 years. They've been on a job for 7 years. They have stable income, those types of things. They have high credit scores. And then if it gets down to the money, then we just have to find a program that's going to help you with the money that you need to buy the house.
All right. A couple more questions. I know, we're thinking about the time. What are the most important things a buyer should consider before applying for a mortgage?
I think the number one thing is, are you ready? Are you ready?
Okay.
That's a lot of people move before they're ready. There's a timing issue into buying a house as well. And when I say timing, I'm not talking about a buyer trying to time the market to find out where the rates are and all of that stuff. As I said before, it's better to buy real estate and wait than to wait and buy real estate.
Mhm.
But you know where you are. For me, I'm gonna throw it out there. For me, I have to have peace in whatever I do. And there's no way for me to have peace without prayer. So you got to figure out where you are and how you're going to get the peace to move forward based on where you are. And if you determine that now is the time, then you move forward as quickly as possible. But don't let anybody else kind of determine whether you're ready or not. And then sometimes you may not know whether you're ready or not. And then that's when you have a mortgage consultant to kind of direct you and guide you from a financial standpoint. But you know whether you're ready to accept that responsibility of buying a house. That is the first thing to do.
Okay. Lastly, are there any final tips for our viewers?
I would just say know the benefits of buying a house.
Okay.
And again, because if you don't have the whys behind this wise decision, then you're not going to have the fortitude to move forward. Some people are buying for the wrong reason, which I alluded to. And when I bought my first home, I was thankful that I never ever was in a rental situation. After I came home from school, went back to my parents' house, and I just said, look, I'm never going to rent ever. And so I was able to buy my house at a very early age. But when I bought it, I didn't know the benefits, all of the benefits. I just knew that I did not want to rent. And one thing I learned is my home equity grows faster than my money in the bank. That's the number one thing I found out. The equity grows faster than my money in the bank. So know the benefits of having equity. That's why you buy a house. I also knew that my finances can move faster by using other people's money. So no one has $200,000, $300,000. And these are my epiphanies when I bought my first house. I figured out, wow, if I use the bank's money to buy this asset, it's going to give me the biggest benefit because I can't afford $200,000 and $300,000. So that was an epiphany. And then the last epiphany that I got was people with money pay less in taxes than people who don't have money. And I found out the financial benefits and the tax benefits by buying this house. I found out that, okay, when I bought my first home, if I want to buy a second home, I can sell my first home and I can make up to $250,000 and I didn't have to pay a dime in taxes. And so people who don't buy homes, they don't understand how the rich get richer. And they use this because they understand the tax system. And so in order to understand the tax system, this is the first thing you need to do is buy a house so that you can get into the game with everybody else. Because listen, we're going toward the have and have nots. That's just where we are going in society. So I just really encourage, again, know the benefits of buying a house, understand the benefits. I would love to talk to anybody about the benefits about buying a house. And then the last epiphany I had was I can use this particular property to buy other properties. And so I took equity out of one property, bought another property, took equity out of this property, bought another property. Guess what? At the ripe age of 23 years old, I was setting up my retirement plan by buying homes even back then. So it's a way to increase your asset base as well. A lot of people don't want to do that, and that's fine. But at least buy that owner-occupied property and enjoy the financial benefits of it.
So I'd like to thank you for your time. Definitely, as I told my clients and my viewers, that I wanted to do this for the very reason that we've been speaking. I want people to have knowledge. I want them to have different perspectives. And so, we're going to start this series and we're going to, everyone's going to have a day and I'm going to let you know when that is. But I think it's the most important aspect of it for me is education. Because without education, you can't even move. You don't know how to move forward. You don't know how to move backwards. You don't know, should I move to the left or should I move to the right? But you cannot make an informed decision until you have some knowledge, period.
That's right. That's right.
All right. So I want to thank you for your time and I'll talk to you soon.
It's been a pleasure. Talk to you very soon.
All right. All right.
Bye-bye.